In this video, I'm going to talk about free cash flow, specifically what free cash flow is and how you would go about calculating it. So let's start with defining it. So free cash flow, we're talking about cash flow that has to do with a firm's operating decisions. And by operating decisions, we're specifically excluding the firm's financing decisions. Okay, so this is cash flow that does not have to do with the firm's financing decisions. Well, what do we mean here? What are we talking about? Well, when a firm generates sales, it's going to have cash from those sales, typically, or accounts receivable that it converts to cash. In any event, the firm is generating cash, otherwise it wouldn't exist. And now the firm is going to reduce that cash when it pays employees, when it pays the electric bill, and so forth. It's going to be reducing the cash that it's received. So when we have that going on, ultimately we're going to get to some amount at the bottom as we just keep taking out and deducting cash. Ultimately, we're going to have some net cash flow or some cash flow that's left over. And what happens is that cash flow that's left over, now it's going to go to two primary groups. You've got this, so we'll say this cash flow that gets left over you can go to lenders. That's who's going to have the first claim on it. This is like a bank, bondholders, and so forth. And the second group would be the owners of the firm. So whatever doesn't go to the lenders in terms of interest payments and so forth is going to end up going to the owners. And if this is a publicly traded firm, then we're talking about the shareholders of the firm. So ultimately, the firm generates cash through sales, through revenue. Then it goes ahead and it pays the employees, it pays its bills, and then you're left with some cash. And then the firm takes that cash and it has to pay its lenders first, assuming it has borrowed money. And then whatever's left over, the owners have a claim on that. So when we're talking about free cash flow, what we're talking about is the cash flow that's left over, so to speak, before it's distributed to lenders and owners. So before any interest is paid, before any dividends are paid to the owners, what's the cash flow before that happens? So when we think about this, we can look at it in terms of an equation that we use to calculate free cash flow, and that might make it a little bit easier for you to understand. So on the left side, we've got free cash flow, and the way we're going to calculate that, we're going to start with earnings before interest and taxes. Okay, and then we're going to multiply that by 1 minus the tax rate. Now, why are we doing this? Why don't we just take, for example, net income? And so the reason that we don't look at net income is because we want to get the effect before any interest is paid. If we just looked at net income, then we're already factoring in the interest tax shield. And that's something we said we don't want to deal with, because we're saying with cash flow before considerations about financing decisions or things involving lenders or the owners or any kind of financing activities at all. So we're taking earnings before interest and taxes, and then we're scaling that by 1 minus the tax rate, because our tax, we're going to deduct out the cash flows from that, not considering the tax shield from the interest. And then we're going to add back depreciation, because as you know, depreciation is a non-cash expense, and that was something that was deducted in calculating earnings before interest and taxes. So we're going to add that. We're going to add that back. Then we've got to subtract out capital expenditures. Those, as you know, were not expensed in terms of earnings before interest and taxes, but it was a cash flow. So we have to go ahead and we have to back out the CapEx. And because as we spend money on machines or equipment, that money is obviously not available to lenders and owners for distributions. And then lastly, we're going to subtract the increase in net working capital that took place during the period. Now, when we're talking about increase in net working capital, specifically, we're talking about non-cash current assets. Okay, so inventory, accounts receivable, those type of assets. And then we're going to subtract out the non-interest bearing. So we're going to subtract non-interest bearing current liabilities. I'll just abbreviate CL. So we're basically taking the current assets, not including cash. So whatever the current assets are, deduct cash, those net current assets, and then we're going to subtract out any current liabilities that are not bearing interest. So for example, the current portion of long-term debt would not be included, even though it's a current liability. That's an interest-bearing current liability, so that would not be factored into our calculation of increase in net working capital. So this is our equation that we go ahead and we use to calculate this. But let's look at an example. So if I just scroll down a little bit here, I've got an example. So if we look at, let's say, a firm that manufactures bottles, ABC Manufacturing, they make beer bottles. So we can go ahead and calculate the free cash flow if we have these items at the left of the screen. Oop. Actually, want to include all the way down. There we go. So we can just use our formula from above. We see here, we'll just take the free cash flow is just going to be the earnings before interest and taxes times 1 minus the tax rate plus depreciation minus CapEx minus the increase in net working capital. So once we know what those things are, it's really kind of mechanical to go ahead and calculate this. So what we're going to have is 100 times, so this is our earnings before interest and taxes, times 1 minus the tax rate, and we got the tax rate is 40%, so times that. Then we're going to add back depreciation because it's a non-cash expense, so we add 15. And then we're going to subtract out the CapEx of 35, and then we're going to subtract the increase in net working capital of 10. And if you go ahead and you calculate this out, what you're left with is free cash flow of 30. So that's the amount of cash flow to the firm after the firm's operations, but before considering any financing effects or financing decisions that the firm has made. Now, it just bears mentioning that there's an alternative way to calculating free cash flow here. So you can also calculate free cash flow as equal to the EBIT, the earnings before interest and taxes, times 1 minus the tax rate. But instead of looking and breaking out specifically by depreciation and CapEx, what you can go ahead and do is just say, okay, I'm just going to subtract out the increase in net fixed assets, which I'll abbreviate NFA, increase in net fixed assets. And then, of course, you still take out the increase in net working capital. So sometimes you might have a professor gives you a problem and they don't specifically give you depreciation and CapEx or something, but you have a balance sheet and you can see the change from the previous year balance sheet, and you can see the change in net fixed assets. You can go ahead and still calculate free cash flow. And so when we look at this net fixed assets, what net fixed assets is we're talking about gross fixed assets minus accumulated, I'll just abbreviate this here, minus accumulated depreciation. And if you calculate free cash flow using this will get you to the same place as our original equation for free cash flow.